Hello, traders of tackle trading. Welcome out to Tackle Trading's Tackle Trading 101 on the option Greeks. It is my pleasure here tonight to introduce a good friend of mine, a great trader, an amazing instructor, all around just good dude, Mr. Tyler Craig. Coach Tyler Craig of Tackle Trading is here to present on the option Greeks, and I am so excited. I've gotten to, Tyler, you know what? I just got done with the Step System Mastermind Group for Tackle Trading. It's a monthly webinar we do on swing trading over there for the Step System. Had a lot of the Tackle Trading Pro members over there. And we just got done with an hour and a half of rock solid technical analysis. And I said, all right, guys, I got done, right? And I said, all right, guys, Tyler's coming up here in about 5 minutes from now. Listen, I've seen some of this presentation, okay? I've seen some of this presentation, and I got to tell you, there's some slides you haven't seen. There's some new slides here. And I am so excited to watch you do your work tonight, teaching our community and the amazing traders out there, subscribers to Tackle Trading YouTube, about the option Greeks. And Tyler, you know, you gave a webinar a couple of weeks ago where you detailed basic options. We talk about the Greeks and basic options. Tonight, you're going to go into some detail on the Greeks, and I am looking forward to that. So with that said, the great coach of tackle trading, Tyler Craig, author of multiple different systems, including the Bear Market Survival Guide, Cash Flow Condors, and one of the finest technicians I have ever had the pleasure of being around. Tyler Craig, Tackle Trading 101 presents Option Greeks. Enjoy it, my friend.
Thank you, Matt. Much appreciated. We have some delightful content tonight. I was just going through the slide deck for another run through before I started. And if you like pretty slides, you've come to the right place. This is going to make my job relatively easy. I've got my stylus. I've got my, I forget what you call this. I'm going to draw tonight a little bit as I explain these things.
It's called a piece of paper, Tyler.
It's a piece of paper. I got a tablet. There we go, Matt. Tablet. Got my tablet. Let's do this. Per Matt's comment, yeah, we did an intro to options here recently where I talked about the basics of calls and the basics of puts. And in that, I get a little bit into Greeks, but not really a deep dive. So tonight we're going to see how far we can go into the Greeks. Why are they important? And more than just the theory, right? Like, we're very practical at tackle trading. We're not just academics and understand intellectually how things work, but how do they help us make better decisions? How do they help us understand these instruments that we trade? And ultimately, how does it make me more money? That's my objective tonight, is to answer those questions and help empower you guys to use options, because options are great. Option contracts are fantastic trading vehicles. But to be fair, they're a little bit more complicated than stocks. I'm going to make them as simple as possible through tonight's conversation. To kick this off, make sure I'm on the right slide here. I'll pull up the bio slide. You've already seen the disclaimer. We're going to do some examples today at the end. I'm going to try to do some practical examples and build some trades, show you some what ifs with how the Greeks influence my decision making on these different strategies. Coach Matt already gave the intro, so you already know who I am. If you're new to tackle trading, we have an entire ecosystem built around empowering traders, helping them connect, helping them succeed, helping them understand how to use the markets to their advantage. Definitely come check us out. All right. We put a lot of work into these free webinars. We put even more work into the stuff we do on the back end when you come in and see us on the inside. So we are here to help. If you want to learn how to trade, you come to the right place. Give us a chance. Come be a part of Team Tackle, and you will love every minute of it. Tonight, I've got a couple of specific topics, Greeks in general, but specifically delta. What are the two dimensions of delta? Theta, we're going to talk about time decay. We're going to talk about the role of gamma. We're going to talk about volatility and Vega. I have my work cut out for me, okay? It's kind of unfair, because I could spend an hour on every one of these topics. To try to do all of them in 60 to 90 minutes, we have our work cut out for us. This is going to be, I think, let me rephrase that. I'm going to focus on the most important aspects of each one of these. There's a lot of detail if you want to dig into the Greeks, but I'm primarily going to say, okay, if I were to teach you 5 minutes on delta, here's what I think is the most important thing to know. Okay. I won't be able to teach you everything because there's a lot, but I'll cover the most important stuff in this webinar. I got to start with a little bit of review for those of you that joined me on a previous webinar on option contracts. You can't just jump into the Greeks without first understanding what an option contract is, what is a call, what is a put. Let's get on the same page. Okay, let me introduce you to those, or maybe refresh your memory if you already understand them. But the options market is comprised of two vehicles, okay, two different contracts. You have calls and you have puts. This is the definition of an option contract. And the Greeks are essentially the characteristics, okay? The way that I like to introduce the Greeks is to think about, if I were going to have you over to babysit my kids. I got 4 kids, 3 boys, 1 girl. If I wanted you to be successful as a babysitter, I would need to tell you about each one of my kids. They have quirks, they have nuances. They're all different, right? Each one of my kids is different. Maybe one of them has an allergy. You need to know that, right? Maybe one of them, if he stays up past 8 p.m., you're going to hate life. Okay. So got to get him in bed by 8. To make you successful, I would go through each child and I'd say, this is the do's, this is the don'ts. These are the characteristics of my kids. It's kind of what the Greeks are. When you learn an option strategy, something as simple as a call and a put, you can understand just basically, oh, it's a call, it's a put. Yeah, but go one step further. Like, tell me how they behave. What are their characteristics? Help me make an informed decision on how to manage this trade, just as if I was babysitting your kids, right? So on a basic level, this is the definition of an options contract. That's a contract between a buyer and a seller. And that is important with Greeks, because if you're the one who bought the option, the way the trade behaves is completely different than if you're the one who sold the option. And the Greek characteristics are opposites depending on which side of the trade you're on. So what's good for the buyer of the option may be bad for the seller of the option, and vice versa. So that's very, very important. Did you buy the option? Are you long, in other words? Or did you sell the option? Are you short the option? If you don't know the answer to that, then it ain't gonna work. It's not gonna work. But that's the beginning. You can buy it, you can sell it. The contract gives you the right, but not the obligation, to buy or sell a specific stock at a specific price on or before a specific date. And I just realized that my stylus and tablet is not set up right. So you give me 1 second to make sure that's going here. You're seeing how the sausage is made here, a little behind the scenes. I have 3 monitors, and if this sucker's not set up on just the one monitor, then well, we're in trouble. We are in trouble. Gotta have is it monitor 1? We're gonna find out. I can't remember if it's monitor 1 or monitor 2. Uno momento, friends. Oh, it wasn't monitor 1. We got to get to monitor 2 here. Monitor 2. Oh, you know what? I had the picture up there. It's been so long since I've had to reset this. I forgot. Yes. Oh, all right. Now we're firing. Now we're firing. Okay. You have 2 types of options. We talked about a contract that gives you the right to buy a stock. That's a call option. We talked about a contract that gives you the right to sell a stock. That's the put option. I like the telephone here. If you want to call somebody, got to pick up the phone. So when you hear calls, think up. Okay. You want the stock to go up when you purchase a call option. We're not talking about selling options. We're talking about buying. Buying calls is a bullish strategy. Gives you the right to purchase a stock. Puts. Well, I guess when you're done with your phone call, you put down the phone. So when you think puts, think down. Puts give you the right to sell a stock. And so if the stock goes down in value, the put goes up in value. Okay. Put options increase in value when stock prices decrease in value. And when you look at the specifications of these contracts, you have the right to buy a particular stock at a particular price on or before a particular date. So these contracts are very detailed. Okay. To give you an example, if I have a stock that's at $100 and I'm bullish, okay, I'm looking at calls, I can lock in the right, and let's say this is Apple, by the way, I can lock in the right to buy Apple, that's the stock, right now the stock's at 100, I could lock in the right to buy it at a discount if I wanted to. Maybe the set price is 95, we call that the strike. It's like this is the price at which the deal is struck. Right? So we strike a deal. You can buy the stock at 95. It expires at the end of March. So you got about a month of time. Okay, that would be detailed in the contract. And those things matter, the strike price, the time element, that influences how much you got to pay for this option. Okay, and then presumably if the stock went up, right? If the stock went up, this call option would go up in value. Right? This call option will go up in value. And then we could do the same thing in creating a put option, right? We could say, okay, we're gonna look at a put option on Apple. Why would I look at a put? Well, because I'm bearish. I think the stock's gonna go down. And instead of shorting the stock, I want to buy a put contract. Gives me the right to sell Apple. Well, look, if I have the right, let's say I have the right to sell Apple at $105. If Apple goes down to $80 and I have the right to sell it at 105, that's pretty valuable. It's pretty valuable. And so that contract's going to go up in value if the stock goes down. Now, whatever the expiration date is, I don't know, let's say it's 6 months from now. What would that be? March, April, May, June, July, August. So August. Hey, that gives me a lot more time than the call option. I wonder what that might do to the option value. Typically, time has value. The more time in the option, typically, the more you got to pay. Okay, so just general idea here, right? Just getting the basics. Calls you want to buy when you're bullish. Puts you want to buy when you're bearish. Got to pick the underlying stock you're building this contract on. And there's lots of different stocks that have options these days, hundreds and hundreds and hundreds. Any popular company you can trade options on. They'll have calls and puts listed, right? You got lots of strikes and lots of different months. One of the challenging things about options is there's so many choices. I mean, if you want to trade Apple stock, you have one choice. Everybody on the planet, even though there are millions of different people, there's only one Apple. There's only one company that trades under the ticker AAPL. If I buy Apple and somebody in London buys Apple and somebody in China buys Apple, we're all buying the exact same thing. There's only one stock for Apple. But there are hundreds of option contracts. And that can get a little bit overwhelming for people. They say, Tyler, there's not just one call option on Apple. There's calls that expire anywhere from 1 week from now to 3 years from now, and everything in between. There's not just one strike price. There's dozens, there's hundreds of strike prices. So it can be a little bit overwhelming. And part of the learning process is understanding the differences between why you might pick 1 month versus another, why you might pick one strike versus another. And for shortcuts, we just create rules. Just say, hey, every time you're going to do a covered call, use this strategy, use these rules. in other words. Every time you're going to buy a call option, this month and this strike, that's your default. And so this is part of the educational process, is getting familiar with the rules, the guidelines. And then it's not like, oh, I got to do another trade. Got to spend 30 minutes finding the right option to buy. Nope, more like 30 seconds, because I already know the rules. I already know the rules. Okay. How is an option priced? Ultimately, you getting more familiar with the Greeks goes hand in hand with you getting more familiar with option pricing. Okay. And here's what's interesting. If we asked, well, how do you figure the price of a car? How do you figure the price of a car? Well, I mean, wouldn't you kind of say, well, it's all about demand. How much demand is there versus how much supply there is? I mean, that's a big part of how expensive a car is, right? Supply and demand. But it goes kind of more, there's more involved there, because you got to have certain raw materials to build a car. You got to have rubber for tires, right? What's the cost of rubber? Got to have leather for the seats. What's the cost of leather, right? You got to have glass for the windshields. What's the price of glass? So you have all these inputs to kind of figure out what's a fair price for a car. Okay, you can't buy a car for $5,000 if it costs $50,000 to build the car. Okay, you know, it's not going to be possible to buy it at $5,000. And so having kind of a standardized way of pricing a car is well, important, so that you can make a market, so that you can know as the buyer that you're paying a fair price, as the seller that you're getting a fair price, you know, for the good. And that's true with cars, that's true with options. And this idea of paying a fair price is important, because if everybody thinks they're getting ripped off, nobody's willing to play. And it took somebody to come up with a formula, a standardized way of pricing options, before they really kicked off and became popular and liquid. So if you go back in history, before 1973, options trading, it was a one-off thing, right? Between big parties that would make idiosyncratic or unique contracts for a specific situation. Very laborious process. Okay. Maybe the guy in New York is trying to price this deal different than the guy in London. So there wasn't a standardized, transparent, widely accepted way of pricing option contracts. And then 1973, got three mathematicians. They say, hey, this is a problem. Let's fix this. Let's come up with a formula so that everybody can price options the same way. We can find out a fair price, so nobody's getting screwed, nobody's overpaying, nobody's underpaying. And then that will induce more confidence into the marketplace, and people will start using these contracts for whatever they want to use them for speculating, for hedging, for investing. And then it could be another way of just making the marketplace more dynamic and more flexible, where you can really structure risk and control your exposure a lot better. So the formula we're talking about is the Black-Scholes model. Okay, that came about in 1973. All right. After that, options launched on the Chicago Board Options Exchange. And if you look at a chart of options trading since then, it's a hockey stick. Like it's just gone through the roof. People love these contracts. And it all goes back to Fisher Black, Myron Scholes, and Robert Merton were the three mathematicians. Got a Nobel Prize for it. Okay, I mean, that's pretty nice. You get some money when you get a Nobel Prize. Got a little award there. And look, because of these guys, we can trade option contracts. So this pricing model is really where the Greeks come from. Okay. And there's different variables, and you don't have to know the calculus or really the mathematics behind it. What you do need to know, if you want to get familiar with how options work, is the inputs. Okay. And the analogy that I like is baking. Look, if you're going to make a chocolate chip cookie and you really want to get intimately familiar with that cookie, like you love cookies. If you really want to know what makes a chocolate chip cookie so good, go read the ingredients, right? Go get the recipe. And, oh, I got butter. No wonder it tastes so good. Oh, there's some sugar in there. Okay, that makes sense. There's some chocolate chip cookies. There's some flour, a little bit of vanilla, da-da-da-da-da. All right, now I really understand why this cookie is so good. And matter of fact, I could tweak the ingredients and probably make a pretty educated decision on what it's going to do to the cookie. What if I double the number of chocolate chips? Hey, it's going to be more chocolatey. What if I double the amount of sugar? That's going to be sweeter, right? What if I double the butter? All right, well, now you really understand what's making this thing work, right? With the options pricing model, there are inputs, and there are only 6. There are 6 inputs, and they're actually listed here. This is from a Khan Academy video. If you look, let me go yellow here. The stock price is one of the variables in the formula. So are we pricing this on a $100 stock? Are we pricing this on a $50 stock? Okay. The strike price, he's calling it the exercise price. Yeah, good enough. If this is a $100 stock, are we pricing a $100 strike call or put? That matters. Or is it a 90 strike call or put, right? You've got interest rates. Okay. The cost of money is important. By the way, there are 2 supplemental things I would point you towards if you want more on tonight's conversation, more information. The Trading Justice podcast, TJ podcast. I cut a video with Tim. That's more audio, the video, but did an interview with Tim talking about the Greeks. Okay, go watch that. On our YouTube channel, if you go to videos and you look at the Jedi options, I did a Jedi options segment last week on the Black-Scholes model. Okay, I'm giving you a big, quick overview here today. So interest rates matter. Time, look at time over there. So time is the 4th variable. Is this a 1-month option or a 6-month option? Okay, volatility. Okay, volatility. That's the 5th input. Where's number 6? Well, number 6 is dividends. Okay, dividends is number 6. And those are kind of linked to the stock price. Okay, you got to adjust the stock price for dividends. Those are your 6 inputs. Okay, not crazy. I mean, it looks complicated, right? But it's not 25 inputs. It's only 6. Get 6 inputs. You know this information, you can price an option. You want to get really familiar with this, you do what you told your kids to do when they wanted to learn how to bake. You gave them an easy bake oven, some simple ingredients, and you said, go make me some cupcakes. Go learn about how you have to have the proper balance of flour and sugar and butter, right? Here's your easy bake oven. If you want to become familiar with option pricing, go play with an options pricing calculator. It has a section for inputs. You can put in the different inputs, click a button, boom, it'll bake an option. It'll tell you, okay, here's a call option, here's a put option. Then you can tweak it. You could say, well, what if the price goes up of the stock? What if time passes? What if volatility changes? Switch it up, hit the button, ding, it'll tell you what the impact is on the option. Okay, so option pricing calculators, inputs, create an option. You spend, however much time you want on that, but the more time you spend doing that, you're like, okay, there's some logic. It's rational. It gets to where it's intuitive in terms of how an option behaves. Okay. Well, listen, I thought this conversation was about Greeks. Let's get to the Greeks. This is the necessary prerequisite, okay, to the Greeks. They go hand in hand. Each one of these inputs corresponds with a Greek. If you know the inputs, you'll start to know the Greeks. Or said the other way, as you get more familiar with the Greeks, you'll get more familiar with the inputs to a pricing model. Okay? They go hand in hand. All right. So without further ado, let's meet the Greeks. Let's meet the Greeks. You got delta, you got theta, you got Vega, you got gamma, you got rho. We're going to listen, no offense to rho, okay? No offense, rho. You're not that important, all right? Striking you from tonight's conversation, we got delta, theta, Vega, gamma. Rho we'll worry about later, okay? Not that important. Why? Oh, go watch the podcast, right? I did with Tim. Trading Justice podcast. Delta. Okay, listen. Pop quiz. Do you see the genius behind the slide design? Why pick architecture for delta? Why should this have things going off in your brain based on my prior introduction, my prior slide introduction to delta? Let me go back for a second. Take a look at delta. I glossed over this. Look at the symbols. Okay, there's a Greek alphabet, I've been told. Okay, there's different symbols that represent different Greek letters. Delta is a Greek letter, I believe. Okay, what does it look like? A triangle. Oh, dang. Okay, we just found delta in nature. I love it. Got not that, I mean, architecture is man-made, but I guess it exists in nature. We found delta in architecture. Got a nice little triangle there. Well done, Christian. Christian created the slide deck here. Very nice. Okay, so delta, what does delta do? What does it measure? Well, D for delta, D for direction. Got some alliteration, I guess, delta for direction, or a little way of linking the two, right? D for delta, D for direction. Well, there's kind of two different aspects that we focus on with delta. The first is delta measures the rate of change. I think I want yellow here. Rate of change specifically for the option value, right? So here's the definition. Delta gauges the change in an options value given a $1 increase in the underlying stock. So if the stock goes up $1, delta tells you how much the option will go up or down. Okay. So what do we mean by that? Well, I'm going to get into that in the next slide, but let me mention one important thing here. Stocks have delta. It's basically one. Let's take out that 0. It's 1 per share. Okay, 1 per share. Now, this makes sense. If you buy 75 shares of stock and the stock goes up $1, how much are you going to make? You're going to make 75 bucks. So it's 1 for 1, right? It's 1 for 1. Now, that's if you're trading stock. If you're trading options, the delta will range between 0 and 100 if we're talking per contract. So if I buy a call option, I might look at the option chain and it might say, this has a delta of 75. Say, oh, so if the stock goes up $1, I make 75 bucks. True. Correct. Now, sometimes, even though you're trading an option, they'll express the delta not based on what your exposure is per contract, but based on what your exposure is per share. And if that's the case, it doesn't go from 0 to 100. It goes from 0 to 1. So that's where that 0 to 1 actually comes into play. It might say your delta is 0.75. Now, I didn't tell you this, but option contracts control 100 shares of stock, typically. And so if your option controls 100 shares of stock and your delta is 0.75 per share, you take it times 100, it's 75. So depending on the speaker, they may say, oh, that's a 0.75 delta. Okay. Or they may say, oh, that's a 75 delta. Same thing, same Z's. I say 75, I'm talking per contract. You say 0.75, you're talking per share. Okay. The options chain, that's the little tool you see in your brokerage platform, by default lists everything per share. When I look at my monitor tab and I look at my open positions, by default, it tells me what my delta is per contract. In fact, often it's just what the total delta is, but it's not stating it as a decimal, it's a whole number. Okay, enough on that. That's the first definition. Helps us know how much money we make if the stock moves. The second definition speaks to volatility. I don't know why I said volatility. I'm just kidding. The second definition speaks to probability. Probability. It gauges the probability of profit. We'll talk more about that in a second. Let me go to the next slide. Let's start with the delta direction piece. This is an options chain. This is actually from Tastyworks. Got this screenshot from Tastyworks. Okay. I've got calls on the left side. I've got puts on the right side. I have a delta column for both calls and puts. Now, notice the delta column for calls is positive. These are positive numbers because when you buy call options, you have positive delta. You make money as the stock goes up. Puts over here, it's kind of small, but these have negative numbers. Okay, the deltas are negative because it shows that you lose money as the stock goes up. Because again, delta is based off a $1 increase in the stock. Well, that's good if you own a call option. It's bad if you own a put option. 50, see this orange line right here? That's the stock price. So anything above that is in the money for call options, and below it is out of the money. For puts, it would be the opposite. In the money puts right here, out of the money puts right here, separated again by the stock price. Well, you'll notice these in the money calls, the delta is 93, 92, 91, 89, 86, 82. These are higher delta options because they're in the money. Now, I didn't explain that. I'm just telling you, in the money options have higher delta. Okay, just take it at face value for now. Out of the money options have lower delta, 39, 32, 25, 20, 16. Well, it bottoms out at 0 and it tops out at 100. Or if we're talking per share, bottoms out at 0, and tops at 1. Just depends on if you're talking per share or per contract. So if you bought this 46 call with a 77 delta and the stock went up $1, you'd make 77 cents per share or $77 per contract. Is that helpful? I don't know. I mean, do you want to know how much money you're going to make? See, this idea of how much, I think, is the most important question that you can think about with options. How much? I misspoke. This is the most important question you can think of with the Greeks. They answer this question. If you buy a call option, you're going to make money if the stock goes up. Great. How much money am I going to make? Ask Delta. He'll tell you. Hey, if you buy a call option, you're going to lose money if the stock goes down. Okay. How much? Ask Delta. He'll answer the question. He tells you how much you make as the stock goes up or down. Another example for you. We're going to look at a bull and a bear. Okay, this chart or picture in the background. This is like if a bull and a bear fell in love and they had a baby. It would look like this. He'd be half bull, half bear. Okay, we're going to focus on the bull side. 3 different ways you can get bullish. Okay, you could buy the stock. That's a bullish trade. You could buy calls. That's a bullish trade. You could sell puts. That's a bullish trade. Those are all bullish. They all have positive delta. Let's say you bought a call option. It's the 100 strike call. It costs you $4. It's $4 per share, which means it's $400 for the contract. The delta is 50, which, by the way, tells me it's an at-the-money option. Okay. So what if the stock goes from 100, which is the current price, up to 101? If the stock goes up $1 and the delta is 50, the option will go up in value 50 cents. So it'll go from $4 to $4.50. What about a put? What about the bear side of the equation? You could short stock, that's bearish. You could buy puts, that's bearish. You could sell calls, that's bearish. 3 ways of making a bearish bet. Let's say you bought a put. You bought the 105 put for $6. That's what we would call an in the money put. It's in the money. So it has a higher delta. Also has a negative delta because it's a bear trade. 75 delta. What if the stock goes up? I don't want the stock to go up. I'm a bear, remember? That's not a good thing. So I'm going to lose money. How much? Ask delta. I'm going to lose 75 cents. The option value is going to go from 6 to 5.25. So do you see how the option value of 6, you just subtract the delta and you get the new option value? That's how it works. Mathematically, that's how it works. Now, you have to forgive me. I have not been able to track the chat window. Okay, Tyler ain't tracking the chat window. In fact, there it is. There we go. All right, now I kind of am. So, not that I can track it real time as we go, but I am going to look at it every once in a while. Okay. Okay, so enough of the delta direction. How about delta and probability? I got to speed up a little bit here. Got to speed up. Delta and probability. Let's talk about abstract versus precise. Abstract versus precision. Okay. Delta. Here's what delta is not. Hey, unlikely. You have a small chance of making money. Or, boy, odds of success are highly probable. Okay, that's not how delta rolls. Those are terms of an amateur, or at least somebody who's not trying to speak with precision. Now, I don't know about you, but as a professional trader, however you want to take the term professional, or as a veteran trader, as a trader who wants precision in their life, specificity, I don't like those terms. I like things like there's a 75% chance it happens. There's a 10% chance it doesn't happen. There's a 45% probability that I win. I like those terms. Okay. How do you know there's a 10% chance it doesn't happen? Or there's a 45% probability I win? Ask Delta. He'll tell you. Here's what I mean. We have this concept in trading where we want to know what the probability of profit is. I want to know the likelihood I'm going to make money. Okay. Okay. You get the visual here? You see what's floating around in the background? Probability. Not probability. JK. Bubbles. Bubbles. What do bubbles do? They pop. Pop. That's the acronym for probability of profit. All right. Here's the formula. Delta measures the probability of an option expiring in the money. So we have a $70 stock. I have a stock at 70. The odds of the stock going up or down is 50-50. It's a coin flip. As a result, the at the money option, the 70 strike call, has a 50 delta because there's a 50% probability of being in the money. Now, I'm not Einstein, but I'm pretty sure there's a 100% probability the stock's going to be somewhere. So if there's a 50% chance it's going to be in the money, there must be a 50% chance it's going to be out of the money. So probability of the option being out of the money is just I believe this is called the arithmetic inverse, 1 minus the delta. So if the odds of expiring in the money are 0.5, 1 minus 0.5 is 0.5. Odds of expiring out of the money. Okay, what about an in the money call? 70 delta. Why? Well, because there's a 70% chance the option is going to be in the money. There's a 70% chance it's going to be in the money. What are the chances it's going to be out of the money? 1 minus 0.7, 0.3. Do you see how the probability out of the money and the probability in the money add up to 100 every time? It has to. It has to. Okay, and you can see the same thing playing out on the put side. So as option traders, if you sell an option and you want it to expire worthless, in fact, if it expires worthless, you capture max gain, the odds of expiring out of the money is synonymous with the probability of profit or the odds of success, the likelihood you're going to make your money. So you can put a number on probability using options. You don't have to know you have a good chance of making money. You can actually quantify that. Oh, you have a 90% chance of making money. Kind of cool. Kind of cool. All right, so enough on delta. Listen, delta gets a lot of love because it's probably the most applicable of all the Greeks. I will not be spending the same amount of time on the others. No offense, theta. No offense, Vega. No offense, gamma. Delta measures the change in an option's value given a $1 increase in an underlying stock. Delta measures the probability of an option expiring in the money. And 1 minus delta measures the probability of an option expiring out of the money. So much for delta. Theta. Now, what do you see in the picture? Looks to me like an hourglass. I think hourglass, I think time. I hear theta, I think time. T for theta, T for time. By definition, theta measures the rate at which an option loses value per day. This is an actual options contract. In fact, this is an out of the money options contract. This is a 10 delta put, a 33-day 10 delta put. Look at the bottom. Where's my mouse? Here, mousy, mousy. Okay, yellow ain't gonna work, buddy. Need a dark one. Okay, so 33 days to expiration, and then this is time passing, and this is expiration over here. And then the vertical axis is the theoretical value of the option, which in this case is all time value because it's an out of the money option. Okay, so if the option 33 days out has $73 of value, this is the speed at which it decayed over time. This is the decay curve of an out of the money option, assuming the stock just goes sideways. So what do we discover? Well, options lose value as time passes. Typically, you see this time decay curve. This is the more normal or usual time decay curve. Side note: the reason these two are different is because the typical time decay curve you see is for at the money options. This is an at the money option time decay curve. It shows you that options lose value quicker as you get closer to expiration. Okay, so the danger zone is close to expiration, right? I mean, that's really when options lose value fast. So if you're buying options and you don't want time decay or theta to steal your lunch, don't buy super short-term options. Buy something longer term. Another graphic, picture, chart worth memorizing. This is theta over strike prices. This is a little bit higher, a little higher level, a little more advanced here, but essentially not every strike price has the same theta. So if I'm looking at 30-day options, you would think, oh, they all have 30 days. All these options have 30 days. The in the monies, the at the monies, the out of the monies. So why isn't the theta the same? Because it's not. Because at the money options lose value faster than in the money options or out of the money options. Why? Well, because they have more value to lose. You actually pay more for time with at the money options than in the money versus out of the money. Okay, so more on that in other discussions. You can quantify this. This is again an options chain here. I've got the theta and the theta. Okay, and I've got the 50 strike. And over here, my theta is negative 275. Negative 275. What does that mean? That means that option is losing $2.75 per share per day. Folks, that's $275. Holy Toledo. This option has a very high rate of time decay. So if you wanted to, you could measure the theta on the trades you do. You could quantify how much these options are losing per day. Doesn't have to be a random number. It could be very specific, right? It could be very specific. Okay, so when you look at buying versus selling options, you're on opposite sides of the equation here. So theta is a dirty little thief when you buy an option. He will take money from you. Okay, theta will take money from you. When you sell options, theta puts money in your pocket. Theta puts money in your pocket. And so you can decide whether you want to be a trader that fights time decay or one that essentially benefits from him. And that in turn will kind of tell you, hey, what kind of option strategies am I most interested in? Am I most interested in positive theta trades, which we call cash flow trades, where time decay is delivering your money? Or am I more interested in negative theta trades, right? Where I have to fight time decay. Okay, here is a really good illustration of how theta plays out per day. Okay, a lot moving here, a lot of movement on the slide, but let me break this down. You have at the bottom, not the bottom, sorry, I'm dealing on the top here. Let me switch my color. Okay, so the premium's $4, theta's -5. These are all out of the money options. Okay, and we're assuming everything else stays the same. The premium of the option is $4. Okay, so premium's $4. We're going to look at the value of the option as time passes. So if theta's -5, this option should be losing $5 per day. So if we go forward 5 days, the option would lose 25 cents in value. So the call owner, the one who's long the call, would lose $25. The one who's short the call would actually make $25. So it just transfers. What one person is losing, the other is gaining. Okay. What about another 5 days going by? Well, now 10 days have passed with a 5 theta. Option owner loses 50 cents. The option, look how the option in the middle there has gone from $4 to $3.75 to $3.50. Okay. And then as we continue, you'll see that the option continues to lose value. The option owner that's detrimental to him. And then the option seller is making, again, the same amount that the option owner is losing. Okay. Now, the reality is this is an oversimplification. This is an oversimplification because theta actually increases as time passes. This is illustrating it linearly. Okay. And I'm gonna pop off my video for a second, actually. This is showing it linearly where theta is the same. Okay. Don't get thrown off by the fact that it's the same every 5 days in these increments. What I want you to understand and get comfortable with is that option buyer, the person who long the call, it's to his detriment, right? That the option loses value. The one that short the call, it's to their advantage. Okay. All right. I think that's it for theta. Let me yeah, one other thing on risk graphs, as far as theta goes, when you are short an option contract, you have positive theta. What you'll notice with your risk graphs is that they go up. Okay, so the risk graph goes up over time. And the negative theta, the risk graph goes down over time. Okay, theta goes down over time, or the risk graph goes down over time. So a little bit on risk graphs. I don't really have time to cover those tonight. Here's something interesting with theta. Portfolio theta. Portfolio theta. The theta of each individual position can be added together. So this is a picture of my entire portfolio, just an example here. And what you'll notice is that theta column, you've got 4.75, 15.5. You can add up all the thetas. And then at the bottom, it'll tell you what your portfolio theta is, right? So this portfolio is making $39.92 theoretically per day, $32.92. Okay. Now, what does that mean? Well, all else equal, my portfolio should be delivering $40 a day into my pocket because of time decay. So some people really like to track the theta of their portfolio so that they can understand the role that theta is playing in giving them money or taking money away. Cash flow traders will always have a positive theta portfolio. And they may even have a target. They may say, hey, in general, I like to have my portfolio theta to be 100 or 500 or 1,000 or 50 or, some number, just to know that time is working in their favor and the degree to which it's working. Okay. All right. So much for theta. We got summary here. It measures how much an option loses per day. It's negative when you purchase options. Positive when you sell options, highest for short-term options, highest for at-the-money options. Adios, theta, gamma. And yes, this will be recorded, and you can 100% go back and watch this as many times as you'd like to salivate over these gorgeous slides. Let's talk about gamma. Gamma is the trickiest one. I could talk about gamma for 3 hours. All right, gonna give you a taste this evening. Gamma measures the rate of change of the options delta with respect to a $1 move in the underlying asset. In other words, gamma tells us about the option's expected delta change relative to 1 point change in the underlying stock. Now, I'm going to unpack that, but I want you to understand that there are two types of delta. There's fixed delta and there's variable delta. And stock has fixed delta. So if you buy 10 shares of stock, your delta is 10, whether the stock goes up, down, sideways, up $30, down $30, your delta is the same the entire time. It's fixed. What makes options so cool / complex is that the delta changes. The delta changes. It's variable, in other words. Variable just means it changes. Okay. And so the delta of your option fluctuates between 0 and 100 if we're talking per contract. So how fast does the option delta go from 150 to 100 or, from 50 to 25? Gamma answers that question. Okay, so gamma is the rate of change of delta, in other words. So again, delta for stock is fixed. 1 share of stock is 1 delta, forever and always. Which makes them very predictable and very linear, right? You don't need a calculator and complex math to figure out if you buy 100 shares of stock, how much money you're going to make if the stock doubles in value. You'll make $100 per dollar move. Easy as that. Options are more complicated. The delta changes. How fast does it change? How much does it change? Gamma tells you that. So gamma is like a delta generator. Gamma generates delta. G for gamma, you could think of G for growth. Gamma is the growth of delta. And so when you look at buying an option, I wouldn't get overly stressed about gamma. Honestly, what I would really try to understand is that gamma is the friend of the options buyer. Okay. And so what that means is your gains accelerate and your losses decelerate. So do you want your gains to speed up? Of course you do. Do you want your losses to slow down? Of course you do. I want my gains to speed up. I want my losses to slow down. How? Gamma. Gamma will do that for you. Okay, gamma will do that for you. So one of the perks of owning a call option is you have positive gamma. You buy an at the money call, you have a 50 delta. You're making $50 per dollar increase. And then the call goes in the money and the delta grows to 100. And now you're making $100 per dollar increase. Your rate of gain just doubled. You're making twice as much for the same dollar move in the stock. Why? Because of gamma. He's so kind when you buy options. When you sell options, you have negative gamma. He's your enemy. Negative gamma, what I want you to remember is that your gains decelerate and your losses accelerate. Gains decelerate, losses accelerate. Who wants that? Do you want your losses to speed up? You sell a naked put. You're losing $10 per dollar drop in the stock. And then you're losing $15 and then $20. And so the rate of loss can accelerate when you're selling options. And that's important because when you're doing strategies like naked puts or covered calls or credit spreads or condors, all of those have negative gamma. Okay. Now, do you have to know the exact number? I don't think you do. I think you just need to understand conceptually that gamma is a force in the options market and he can help you or hurt you, and that it manifests itself in your gains or losses. Okay. So I'm always very careful when I sell naked puts or bull put spreads or covered calls because the gamma, because I understand, look, I may not have a lot of exposure right now when I'm selling this 10 delta naked put. I mean, I'm only losing $10 per dollar drop in the stock. But if this put goes in the money and my delta grows to 100, I'm now losing $100 per dollar drop in the stock. My rate of loss can go up tenfold. Worst case scenario when I sell a 10 delta option. You know, you better be careful. Better be careful. Okay, so that's positive gamma, that's negative gamma. We've arrived at our final Greek, Vega. Ooh. V for Vega, V for volatility. Vega is all about volatility. What do we mean, volatility? Volatility is something you see every day. You see it when you go buy milk. You see it when you go get gas in the tank. You see the change in prices. Sometimes milk's cheap. Sometimes it's expensive. Sometimes gas is cheap. It ain't cheap right now. It's expensive. Day to day, as the price of gas ticks up or down, that's volatility. So stocks have volatility too. And it's not so much the direction. It's irrespective of direction. It's the magnitude of the changes. So a stock that moves 5 cents a day is not very volatile. Stock that moves $50 a day is a little more volatile. Not a little, a lot more volatile, right? We care about volatility because it tells you something about the range of outcomes and the probability that a stock's going to do something. Okay. Go tell somebody that some small electric vehicle volatile stock could triple in value It's believable. Go tell them that Walmart can triple in value. It's probably going to take forever. It could. They have done in the past, but it's going to take a while because it's a less volatile stock. And so when you measure volatility, just to put some numbers on there, and ultimately that's the difference with stock volatility and the volatility of milk prices. Nobody measures the volatility of milk prices unless they're an economist who's really geeking out on stuff. But in the stock market, like, volatility is ever present. So we measure it, we put a number on it. And so if it's something slower moving, like an old dog, all right, it's getting old, doesn't move very much. Coca-Cola, no offense, Coca-Cola. In fact, this is actually, I think, a laudable characteristic, right? Many would look at Coca-Cola in times of turmoil and say, gee, we could use some more stability. Go you, Coca-Cola. So the IV index for Coca-Cola, 25%, for example. The IV index, which is just a way of measuring volatility, 77% for Tesla, 3 times higher. So traders will measure the volatility of individual stocks. And more importantly, it impacts option prices. Are you pricing an option on Walmart, on Coca-Cola, Johnson & Johnson, Procter & Gamble, Verizon, these boring staple telecom type companies? Or are you pricing an option on Tesla? Something that is wild. Well, if you're pricing an option on Tesla, you better believe it's going to be more expensive. What if Coca-Cola, I don't know, maybe they find a cure for cancer, and all of a sudden their potential goes through the roof and their stock begins to behave like Tesla? Well, don't you think that's going to impact the options? How much people are willing to pay for calls and puts? Of course. So Vega ultimately measures how much the option's going to change in value if volatility expectations change. So by definition, if implied volatility goes up 1 point, and then whatever the Vega is tells you how much the option value will change. Okay, let me show you an example. Okay, so you have implied volatility, which is just the expectation of how volatile the stock's going to be obviously in the future, not the past. And then you have the option premium, and then you have Vega. So here's the math. Let's say the implied volatility is 30%. And that's driven by the marketplace. It's driven by supply and demand. And the option is currently worth $6. And the Vega is 10. And we're stating it per contract in this context. What does that mean? It means if the implied volatility goes up 1 point from 30 to 31%, the option value will increase at the rate of Vega. Do you see that? Option implied vol went up 1 point. The option premium went up by 10 cents per share, or $10 per contract, because that's the Vega. So if you want to know, hey, if implied volatility rises, how much is my option going to change in value? Ask Vega. Ask Vega. Conceptually, you want implied volatility to increase if you own the options. Conceptually, you want implied volatility to increase if you own the options, because it'll pump up the option value. This is intuitive. If people think the stock's going to move more in the future, they're willing to pay more for the options. So if I own options, I want everybody else to want to come buy these things that I own. And they'll be more willing to do that. They'll be willing to pay more if all of a sudden we think the stock's going to move a lot. Now, conversely, if you're short the option, you don't want them to believe the stock's going to move a lot. You want the implied volatility to go down. So a rise in IV will hurt you if you are short the option. Okay, and again, here's another move. The IV goes from 31 to 32. Option premium goes up another 10 cents because that's the rate of Vega. Okay, That's the general idea. Now, you can really geek out on implied volatility, just surface level discussion here tonight. But again, conceptually, implied volatility tracks supply and demand for options. It goes up when demand for options increases. If you look at the current marketplace, everybody's freaking out about what's going on in the world, justifiably so. A lot of geopolitical turmoil, a lot of uncertainty surrounding Russia, also have uncertainty with the Federal Reserve and interest rates and inflation. If you want to pick something to worry about, you've got a buffet of choices here. And so implied volatility has been increasing. Well, so too have option values. And that has been to the benefit of those who own options. This rise in IV, the VIX right now is around 30. That has benefited those who purchased options before IV rose, because the range of potential outcomes is increasing. People are willing to pay more for puts and calls because of that. All right. I don't personally track Vega, the exact number. Like if you said, Tyler, what's the Vega on your covered call? I'd say, I don't know. I'd have to go check. Vega's like gamma in that I don't care what the number is. I care that you understand conceptually what's happening. Conceptually, you need to understand when you buy options, you'd like the IV to go up afterwards because it increases the value of what you just purchased. When you sell options, you'd like the implied volatility to go down because it shrinks the value of what you're short. And that in turn makes you money. All right. Now, I essentially just spilled the beans, but just so we're clear, buying options gets you long Vega, long volatility, positive Vega, all the same thing. So you benefit from the rise in IV when you purchase options. If you bought a put option, for instance, 3 weeks ago, 4 weeks ago, before the market crashed, not only would you have been benefiting on that put because stocks were going down in value, you also would have been benefiting because implied volatility was skyrocketing. Would have been a double whammy, but double positive whammy. Two good things, right? If you're short options, if you sold puts, for instance, before the market dropped, when IV was lower, it was a double whammy negative to you because you lost because the stock went down and you got a bullish trade on, and you lost because that option contract you shorted, people are buying out the nose right now and they're willing to pay a lot for this. So it's ballooned in value because the volatility is increased. So conceptually, when you buy options, you're long vol. When you sell options, you're short vol. Vol being, of course, the abbreviation of volatility. All right. That's it. That's all she wrote. That's the PowerPoint. So let's look at a couple examples. Okay, just to round this out. I'm going to go for about 5 more minutes and we're going to wrap up. I need to find my mouse here. Come on, mousey. There you are. Okay. Come on. There we go. Okay. So if I was going to do a long call option, let's say I'm bullish on energy and, I'm chasing a little bit here, but I want to buy a call on DVN, Devon Energy. Okay, well, it's a $60 stock. So if I come in here to the trade tab, look at all these call options. Calls are on the, look at all these months. I got lots of choices here. Do I want to buy an 18-day call option or 45 or 235 or 326? Which call option do I want to buy? Okay. Well, I would like to buy, depends on my time frame, quite honestly. If for swing trade, we'd usually say, hey, you don't want time decay to beat you up. Remember, Theta is going to hurt you if you buy a short-term option. Why don't you go buy a July call option? Okay, I'll buy a July call option. All righty. Well, look at all these strike prices. The stock's at 60. You could buy a 60 call or a 55 or a 50 or a 49, 40. You got a lot of strikes to choose from. Well, I mean, I've dealt with Theta. My Theta rules to buy out a couple of months. Usually we use Delta to guide our hand at buying options. Usually we want to buy like an in the money option with maybe a Delta around 60. Here's the 63 Delta option. Maybe I buy this guy. So I bought out a couple of months. That's my Theta rule. I'm buying in the money. That's my Delta rule. What about Gamma and Vega? Well, I'm buying an option. I know I'm long implied volatility. I'm long Vega here. Do I care what the Vega number is? No, not really. I just need to understand conceptually that, I'm going to profit if implied volatility goes up, and it's going to be to my detriment if implied volatility goes down. So I might want to look at that. I might want to go to the chart and see if I can add implied volatility as an indicator, see if I have an opinion. If here's the implied volatility, right now it's actually kind of high. Well, do you want to pay for that call? It's kind of expensive. If implied volatility goes down after buying this option, that's going to hurt you, not help you. What do you want to do about that? I changed my mind. I don't want to buy the call. Or if I do, I want to at least do a call spread so I'm not paying out the nose for these options. So maybe that influences which option strategy I do now that I understand options are kind of expensive. So did I care what the Vega number was? No, I don't even have it displayed. I just care more about understanding conceptually that I want volatility to go up after I buy, or I at least want to make sure I'm not way overpaying for the option based off of them just currently being kind of expensive, as suggested by high IV. Okay. What about Gamma? Well, look, I wouldn't look at the Gamma, but I would understand that if I buy a call, that my profits accelerate if I'm right and my losses slow down. And that's just the nature of the trade. So see, a lot of the strategies you'll see us teach will have Delta rules because that directs you to the right strike price. They'll have Theta rules because that directs you to the right time frame. But they won't really have Vega rules or Gamma rules in the sense that, oh, pick this option or pick that option. It's more so just, hey, here's the characteristics of the trade. You're babysitting my covered call. I want you to be successful. Here's the top 5 things you need to know about my covered call. You need to know it's negative Gamma, and that means your gains are going to slow down and your losses will accelerate. Now, do you need to know that it's at a rate of $5 per dollar move? I don't care as much about that. You need to know this covered call is a negative Vega trade. You need to know you're short volatility and you benefit if IV goes down and you get hurt if IV goes up. That's sufficient. Do you need to know that the Vega's 15 and you lose $15 per point move? No, not really. Just understand the characteristic. So as you go through the options market, as you learn the different strategies, think of the Greeks as the characteristics. When I teach a new option strategy to somebody, I teach them the basic idea, and then I teach them the Greek characteristics. And it's a wonderful way of being able to jump from one strategy to another and do the mental gymnastics and say, oh, this is long vol, this is short vol, this benefits from time decay, this gets hurt from time decay. It seems complicated, but honestly, just step at a time. And ultimately, look, this isn't going to allow you to predict the future, but it will help you anticipate what's going to happen. It'll prevent you from being overly surprised. It'll teach you which dynamics or variables matter the most. And that in turn helps you make more informed decisions and ultimately gives you a higher probability of being successful. And here at Tackle Trading, that's what we want. We want to inform you. We want to empower you so you can make better decisions. You can still be wrong, right? Market's still going to throw curveballs, but we want to stack the odds in our favor. Being fully and properly educated on the option Greeks, I think, really helps. All right, on behalf of myself and Tackle Trading, this has been quite the enjoyable conversation for me. I'm going to call it a night. If you want to learn more about the Greeks, go listen to the TJ podcast. Dropped yesterday, I believe. Did a little interview with Tim. Go look at Jedi Options on the video playlists on our YouTube channel. You got a slew of those. I did one on Black-Scholes Model last Wednesday. And come check us out on the inside. We've got classes on options. We trade options. We do trade examples. Really teach you everything you need to know about a variety of option strategies. I appreciate you guys coming out tonight. Hope that you found this enlightening, and wish you the best. We'll see you in the next webinar.